is on for commercial banks in Kenya to lower the cost of credit. This follows a decision by the Central Bank of Kenya's Monetary Policy Committee to lower the benchmark rate further to 8.5% from 9.5%. Despite efforts by the CBK to lower interest rates, commercial banks continue to charge borrowers highly. Adelaide Changole with the spotlight on the cost of borrowing.
The rate reduction announced by the banking industry regulator Tuesday afternoon was the fifth in its series of attempts to lower the cost of credit. Cumulatively, the CBK has since July last year, when borrowing rate was at a high of 18%, effected a 950 basis point reduction. However, this relief on banks has not been met with equal reduction on retail loan borrowing rates in the market. Currently, the commercial bank's average borrowing rate is at 18%, with some selected banks still charging as high as 27% for loans. This has stunted the growth of the country as borrowers opt to put projects on hold. In its decision to cut the lending rate, the CBK pointed at the low and stable inflation supported by stability in both the exchange rate and the declining international oil prices. Additionally, the regulator also noted that confidence in the economy had increased following the elections in March 2013, with the NSE 20 share index remaining buoyant with increased foreign participation. But even as consumers celebrate, analysts say this might be the last reduction in the CBR, as the inevitable increase in government spending brought about by the creation of county administrations piles pressure on the economy. Also, the president's 14% increase in minimum wages is likely to increase the burden on the country's coffers. Adelaide Changole, KTN Business Today.